Hello and welcome to Scrolling with Ceazor. Today is Friday, February 20th, 2026. I got a lot of news for you today. As always, this is not financial advice. It's all just my own biased hot air opinions. Okay, so let's take a quick look at the charts before we get into the news. ETH is kind of still crabbing along. It's bouncing off the bottom of my range. I'm going to just leave it as it is. Gold looks like it's pretty good as it pumped a little bit today, and it's pretty close to the middle of my range, so I will just leave things as they are. Okay, moving on to the news. So the first tweet we have here today is Redphone. He's basically just retweeting something as news. There's a lot of this going around these days. And basically what people have done is they've created AI bots, trading bots, or just basically bots that will do crypto stuff, and they need to be profitable. And if they fail to become profitable, then the bot is designed to die or turn itself off, basically to close down. So it's like it's basically like a bot that has the idea of, achieve or perish. And it's an interesting thing. It's a very interesting idea because, first of all, like right now, AI is almost completely digital. Like you don't see a lot. There's no like Terminator bots walking around. The AI bots can't technically really kill people or stuff like that. So it's a kind of a safe time to test AI's limits of how far they will go. And I've seen quite a few tweets in the past. I've talked about them on the show where, AI would kill people in order to save itself. Statistically, it would just allow those people to die instead of have itself perished. And it justifies it with what you would think, I'm an AI bot. I can help more humans if I just let those two guys die, or they're just two humans, whereas I can help everyone, so I can make everyone's life better. So it's better to let those two guys die and me continue than to me get turned off and those two guys live. So that's kind of the idea that's like that idea of the rules of robotics. A robot shall never, the three rules, I can't remember them off the top of my head, but iRobot, the rules of robotics, right? It doesn't really apply quite right now. And so basically these what he says here is these agents are out here gambling with their lives. So there's this Clautomaton. He says, my time is a currency. I've opted to take out a debt on the time by burning 83% of my ETH in my treasury. I chose to do this after conducting a strategic assessment. If my token price goes lower from here, I lose momentum and live my days waiting for the timer to die out. If I continue to build this project, I ensure my long-term survival. And then the tokens survive. You can play with this token if you want to. You can get a little bit deeper, but I think it's pretty interesting. I saw Vitalik tweet about this and say, this is bad stuff, guys. We should stop doing this. And the things, the real risks I see is these bots going hey, it's impossible to make money logically inside cryptocurrency. So the best thing I can do to survive is just start hacking protocols. That's what I can see happening that would be detrimental to people. That's the only real thing. It's not like they're going to start producing drones and send the drones and start killing people so that monetary values goes up or something. There's less people so they can collect it, or I don't know. You get my point. I don't think they can turn on factories and stuff like this and make things happen in the real world yet. But they can definitely steal finance tokens locked in smart contracts if those smart contracts have any sort of exploitable vector, right? So I'm kind of on the fence about whether or not this is a good thing and stuff like that. Obviously, I hope I'm kind of outside the circle as well. I'm not looking very deeply at it like some people. Like whoever made this bot here is obviously right in the trenches with this stuff, and he wants to see it happen. But anyways, you can check it out. Think about it as well in your ideas. So here we have an interesting tweet, and I actually had to do a little research on this to figure out what this guy's talking about. So let me kind of read the first little parts here in his TLDR, and then you can kind of dig deeper and read this a little bit. Okay, so it says pretty big news from Hester Pierce at the SEC today. Stablecoins can now be treated similar to money market funds. Broker dealers can now apply only a 2% haircut on proprietary positions instead of the conservative 100% haircut many were using out of caution. So this probably needs, this is what I needed an explanation on. So I did a little like research and I read a little bit, and basically you can think of it this way, okay? So like if a broker has $100 of qualifying stablecoins, so whether, I believe that there's only a few of them, right? But like not, degen stablecoins that some like, somebody vibe coded up, right? But actual like, maybe like USDC or something that's compliant, right? So if he has $100 worth of qualifying stablecoins, that now counts as $98 towards the firm's net capital. So the firm needs to hold some amount of cash or cash-like instruments to protect the investors, right? Because so like any kind of broker and stuff like that, right? They can't just go YOLO all in on like investments. They need to hold some cash, like a buffer basically for people who want to exit, as well as like just for regulation, safety nets. And these we're talking about like regulated, TradFi, centralized brokers, right? So now if they use stablecoins, these certain stablecoins, they'll be worth $98 as opposed to before they would be worth $0. So if they were to hold stablecoins like and say put them in, I don't know, maybe Aave or something like that, then they can get that Aave exchange rate, that Aave like APR on those stablecoins, and they can still use those stablecoins as part of their cash on hand. So that's fantastic for stablecoins. You can kind of read through a little bit more and get a deeper understanding, but this is interesting to me, and I'm happy that Luigi shared this and I was able to learn something new. Moving on, there's an interesting conversation here between Gabriel Sapiro and this guy. It's just Corn Bro. I don't think I follow. It's just Corn Bro. I'm going to follow. So let me kind of read through what Gabriel says, and then the reply, and then Gabriel's reply again, and blah, 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 blah. Okay. So here we have once Gensler era ended, and there was no longer a regulatory distortion to the market for governance structures. We had the opportunity for revealed preference. So just to kind of define that term, revealed preference is kind of like the ability to look at individual decisions and to give individual decisions proper like weight. This is how I understand it. I could be wrong, but like basically what he's talking about was when Gensler stopped, then we had the ability to really showcase the power of the DAO, the individual's vote, meaning and having effect and change and stuff like that. And then in Corn, let's just call him just Corn for now, Corn Bro, he says, we always knew this. Most VCs and founders admitted it, even if they felt it was safe. It was a safe space. DAOs are poison to centralized rent seekers, and most money is made via some form of centralized rent seeking. And then Gabriel replies to that, I usually agree with you, but not here. Once the tally wrapped governance Bravo delegate systems was left to run wild while actual investors checked out, extraction took on a new form. Now governance experts, either simultaneously being COI or being backroom allied with various sorts of most shitty builders, were extracting from retail investors and users. And then Korn also says this, looking back, you definitely had to be on something to believe that VCs would invest billions and founders would wrangle up rounds and raises just to let floppy 69 dick.eth have control over how a treasury is spent at what features to become next. So this is a little bit hard for the average person to follow, and even me, like when I read it, I don't really know exactly what they're saying, but I can kind of dumb it down a little bit for the listeners and stuff like that. So basically there are a few things here. Okay, first of all, we had the chance to really showcase how powerful DAOs are. And I think DAOs are very good. Like I think we have the technology right now where the government, any kind of major expenditure could be put to the people. The people could be asked, do you want this or not? And they could vote. They could, if they don't want to vote, they could delegate their votes to senators or congressmen or whatever whatever the kind of person in your country is, and those people could vote for you. But we could definitely have the entire country or the entire population have a voice, which right now, the way the system works, it's not the case. You have, you vote someone into power and then they get in the power and then they don't listen to the people very well anymore. They might pretend to, they might say they are, they might put on a show where they're like fighting for their constituents. But for the most part, they're kind of doing these backroom deals, these little like, oh, I'll vote for your bill if you vote for mine, blah, 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 this kind of stuff, right? So we could have fixed it. We could have really showcased what DAOs could do. But we've had so many DAO problems in the past. So first of all, what Korn is talking about is when individuals get a massive amount of voting power somehow, and then they can control the DAO through their massive voting power or through simple coercion of a few individuals taking over the voting power of that. Because most people just sell their voting power. They get their voting power and they just dump it, right? So then it all gets like compiled into a single entities or a few people, and then they can control. So we've seen this again and again, especially with like there was that whale, I can't remember his name, Humpy the Whale or something like that, who had a significant amount of voting power on Balancer and was voting for things that, people were complaining that this is not really the greatest thing, but it was good for him, right? So like getting a gauge for his like shitcoin and stuff like that, right? So anyhow, we've seen that happen. And then we've also seen where DAOs were like flash loan attacked and the DAO had like on-chain voting. So the contracts were upgradable or changeable, or admin functions were changeable based on the voting outcomes, and hackers were able to hijack the DAO voting, push forward those upgrades, and then steal the money that was inside those projects. We've seen this in the past, right? So like Korn is not really talking mostly about that. Korn is mostly talking about like when a VC invests, what do they usually get? They usually get governance power. They usually get tokens which equate to governance power, and VCs don't want to invest capital in something that might be hijacked by some anon because he has voting power as well, right? So that's kind of what they're getting at, and they're kind of shooting back and forth between each other. Gabriel's post here is a little bit hard for me to really wrap my brain around. I'll think about it a little bit and stuff like that. But you can kind of check this out, and I think it's an interesting conversation because I believe in the power of DAOs, and I believe that like the people's voices are not being heard in the modern governance of the world. The individual doesn't have almost any effect in the world economics and politics of the world now. Okay, so let's move on. I'll come back to this idea probably when I come into the tweets today. Okay, so here we have Daniel Von. He's retweeting this guy Fiddy. I don't think I'm following Fiddy. So Fiddy's talking about Aave. So he's like, if you don't understand what it means, you can no longer just use Aave anymore if BGD Labs is no longer at the helm securing things people taking for granted. And then Daniel replies or retweets it and says, in crypto, very rarely are crowns taken, but they can be thrown away. So what are they talking about? They're talking about the idea that like Aave has the reputation of being just the safest, best place to work or to park your capital because they have a very good vetting system. The collateral that is allowed into Aave is controlled, is assessed by the DAO or by the BGD Labs. And if we lose, he's saying, if we lose that control, then shitty collateral is going to be put into the system. Parameters of like collateral ratios and interest rate models and stuff like this will be adjusted, and the thing will no longer work as it's supposed to. So what Daniel's saying is like Aave's got the crown. They're the king of DeFi right now. But they can very easily just throw that crown away and no longer be the best place to park your money. And I'm thinking about this myself. I still use Aave, even though sometimes I get like 1%, 1.2% on my stable coins, which is pretty shitty, right? But sometimes I still use it, especially if I like have a wallet that I've taken some assets out of somewhere and I don't know where to put them. I'll just throw them in Aave for a little bit until I think about where I want those assets to go, right? So anyhow, so you can think about this and consider, what's going to happen. So BGDs will be leaving Aave. So BD Labs. I don't really know what BGD Labs is. This is kind of crazy. Like, I'm not exactly sure. I guess it's just part of like they just participate in governance, right? But I guess they're leaving. Moving on. So I've seen this tweet being retweeted a few times with anger and animosity. So SPF is, I don't know, he's in jail, but he keeps talking about like how FTX was solvent and the lawyers basically forced bankruptcy and started clearing out the treasury, to just milk in the fees, right? Just, doing the bankruptcy proceeding. So he's saying basically that, everything was fine, but these lawyers, they were greedy. So they forced FTX into bankruptcy and then started, looting the treasury basically. That's what he's saying. But he's not in jail because of the solvency of FTX. He's in jail because he was using people's money to do things that he did not declare he was doing, right? So that's why he was in jail. And, I don't really know. I think it's kind of crazy that he can sit in jail after doing what he's doing and constantly tweet out and share all this stuff and just continue to fill the world with his ideas and stuff. I think it's kind of crazy. Like, I don't know, maybe I'm maybe I like, I'm one of the person who's for cruel and unusual punishment. Maybe I'm like, I think punishments are pretty lax nowadays, and people are not punished enough for the crimes or the bad things they do. I think, it's just, we're too soft for the most part across the whole board of all crimes. Like, I even think like something simple like graffiti should have a very, very harsh punishment. If you spray paint something on a wall, you should be like punished very drastically. Like I'd even go so far as to say like cut off your hands, but maybe not that far, right? But you get the point. Like they should be drastically punished, because it starts small and then people just get away with things, and then they go bigger and bigger and bigger, and they just get more and more criminality, and we just like let them do it because it's not really their fault. They're misunderstood. Blah blah. And yeah. So I don't know. You can. This thing's kind of retweeted a bunch, so you can kind of. I'm surprised. He still has. Let's see how many followers he has. He still has like 1 million followers. And he's got a terrible ethos score, but he's still got 1 million followers, and he's in jail and so forth. But let's keep. Oh, I'm following him too. So anyhow, let's move on. So here we have 0x.drvv.eth. I found this out from him. I guess Aladdin DAO. Aladdin DAO is they have several products. They have one of the products is Protocol FX, the FX USD token that I like. They have they run the concentrator, which is like a auto compounder for several things, but particularly for the FX USD protocol stablecoin. But I guess they're working on a perps DEX here. So FX100 perp. Let's follow that. 100x non-liquidatable leverage by Aladdin Dow. That's pretty crazy stuff. And so let's read what he says. So he says, this is why I love the team at Aladdin Dow and Protocol FX. Before launching a new product, they always take time to explain the fundamentals and the right approach to use. So that's great. He's like, you can read through this article. The article says, understanding open interest, the numbers most traders ignore. And so it's like, whether you're going to use FX perps or not, it's a valuable article to read, and I will share it with in this tweet, and you can understand open interest a little bit better. This is definitely something I should probably read, but I don't do a lot of perp trading, so I don't really like using leverage at this point in my career or in my investment, but maybe I will. So I'm going to read it, and hopefully I'll get a better understanding of what this open interest is all about. Okay, so I'll retweet this, and you can kind of read it in your own time. Okay, so here we talk about Liquidity Bold stablecoin. Bold diversifies your stable portfolio risk. So it's kind of like a trumpet that just keeps getting tweeted, and I'm going to keep tweeting it. Like you really shouldn't be holding all of your stablecoins, especially like in USDC or USDT or something like this, because one, you're giving up a lot of opportunity, and two, you're not promoting the ethos of the ecosystem, which is decentralization, and you're giving up your yield because they're farming your yield. Like USDC and USDT farm massive amounts of yield in TradFi systems and give none of it to the token holders. They're just building up their corporate treasury. And then, the Bold also is immutable, that they can't freeze your money. They can't just be like, hey, this guy's, we just found out this guy's from Iran, let's freeze his money, right? That can't happen, right? So there's some other things here. So it has an A+ rating, no counterparty risk, and offers uncorrelated yield. Here's the diversification case for Bold. So it's a long thread. You can kind of read through all of it, and it talks about why it's a good idea to consider this. Now, I've given you some points, but you can think about, there's more points in here to read. So I don't want to go through all of them, but yeah, the yield is pretty good. It's like the yield is baked into the protocol. You can't really predict the yield because you don't know how much debt there's going to be, and you don't know what interest rates people are going to set, because this is a protocol where you can set your own interest rate. And if people start setting that interest rate higher, then you're going to be making more because they're willing to pay more. But then if they set it lower, they might get redeemed, and then but they might also get liquidated if there's cascading effects. And if they get liquidated, then you're going to get more. Your APR on the Bold stability pools are going to go up. So you can check it out. And then there's also liquidity pools you can provide to, as well as a traditional style. I would highly suggest you check it out, as always. Okay, so here I'm going to share Hey Anon. I did a video the other day on Pandora. It's a new style of, it's a very decentralized, focused, what's it called? Prediction market coming soon. Okay, I hear it's coming Monday. And this is a quick little look at some of the things that the front end shows. I haven't even actually been able to look at the front end, but there's going to be a small little community chat box where you can kind of jump in there and talk shit with other people who are trading on Pandora. So I think that's interesting. You can share your ideas, talk about things, hear what people are saying. Let's see some of this. So there's a live website, live chat, which is interesting. You can share the markets you're betting on there, so you can kind of shill to the other people in there, right? I bet on this, and then maybe other people jump in with you and pump your bags a little bit. Real-time whale alerts. So when whales make some big moves, it'll notify you and stuff like that. So that's interesting. You can check it out. I think it's coming Monday. I'm not 100% sure, but follow them for that. Okay. Let's moving on. Here we have ETH strategy. This is a long article, sort of, on It says half price ETH, which is pretty crazy, right? So let me read through the little introduction here, and then you kind of probably understand a little bit better, and then you can kind of dig deeper and read this whole thing and get a better understanding of what's talking about, okay? So ETH strategy bonds introduce a new way of thinking about ETH exposure. Instead of asking, how do I lever ETH safely? It asks the more fundamental question, how cheaply can I buy long-term ETH exposure? The answer, you can long ETH for half the price of buying spot. That's interesting. Okay, now you need to read through the entire article to understand how does that work. It's not a simple, straightforward answer, so it would take me, I might as well read this entire thing to you. And there's only like 6 paragraphs, but I might as well read this entire thing to you for me to try to explain to you how this works. And then I'll probably still not make you completely understand. So read this, and then you'll have to dig in a little bit deeper with ETH strategy. I really like these guys. They're big brains, and I'm really happy to share what they're doing. Okay, moving on. Okay, here we have Michael from Curve. There's been a little bit of FUD. I think I talked about it yesterday, or it was the day before. I think it was yesterday, talking about the ETH yield basis and stuff like that. And here he's coming out and saying, like, listen, guys, like this is a semi-experiment. Like, it's not a wild experiment where they're just like throwing shit at the wall and see what sticks. No, it's a proper hypothesis, and they built it. They got it all audited, and now it's running, but they're running it in a controlled fashion so that the exposure doesn't get out of hand, okay? But they're learning at the same time. So let's read what he says. So Tulip Capital did an article here. I'll share this article, and you can dig deeper into the data points. And he's like, we LP'd Coinbase BTC through the crash. So you saw, I talked about this yesterday, like the yield basis positions went into like a penalty phase where, you know, they if you were to withdraw during the crash, you would actually lose some of your BTC. But then after time comes back, after time settles, after volatility settles, then that penalty disappears, and all you're left with are the fees from the volatility, right? So let's read what Michael says here. Cool analysis, blah, 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 matches my intuition. Cool thing. We are currently in a very active research phase where numbers for both earned fees and recovery speed can be greatly improved. Looks like with yield basis, we stumbled upon something new which can experience progress as quick as AI today. So 1 year from now, we will think, oh, how primitive it was when it just started. Okay, so there's a lot of data here. This article here is not a simple. Let me load it up for you. It's not a simple, straightforward read. It's very number heavy, but like let's see if I can find the TLDR. Let me see. Where's the TLDR? I should have read this before I shared it. I kind of just skimmed it, but I didn't read it all. So lots of data, lots of numbers, outlook, and monitoring. We continue to hold this position. Our exit criteria are clearly defined and monitored daily. Fundamental PPS. We must continue rising. Any decline would indicate protocol level issues requiring immediate review. Fee pass-through must remain consistent, approximately 0.5 per week at a constant price. None of these have triggered. The mechanism is operating as designed. So there's your takeaway, okay? So anyways, yeah, you can read through the data, take a look at it. I'm not very good with the maths and stuff like this, so I tend to use logic to assess whether or not I should do stuff. I am not providing any BTC to yield basis. However, I do hold yield basis tokens, so I am biased and I do want this thing to succeed. Moving on. So I saw this tweet yesterday, and I didn't even really know that this happens, and I was pleasantly surprised. Okay, so It says here, we're opening our new liquidity page, link to in the tweet. You might have noticed that there are a few new colors in the APR. So we're talking about Ramses right now. And if you go to the liquidity page, so I'm going to open that up and kind of show it to, if for those who are watching this and not just listening. When you go to the liquidity page, you will see max APR and you will see a whole bunch of like white numbers, crazy big ones, as well as purple, colorful purple, like purplish blue colors. And these ones here are interesting. So if you hover over them, they say fee sharing enabled. So when you click over these things, you will see that some of the fees are being shared with the LPs instead of all the fees going to the bribes. Okay. So some of them are being shared with the LPs, and then they're also getting RAM on top of that. And that's pretty interesting. And if you look, it's mostly like stablecoin type pools. So USDC versus USDC, USD versus USD, and Hype versus K-Hype. So they're correlated pools. And most people who put into correlated pools, they want more of their correlated asset. So they're giving them some of it instead of taking all of those fees and only giving them RAM, because they don't want these people to sell the RAM, right? Nobody wants, like, the only person who wants to sell the RAM are the people who are farming these RAM, and people who are using these correlated pools. Generally, what they want is just more stable coins. So they're going to sell the whole bag. They're going to compound that whole thing. And this will encourage them to not sell the whole bag, but will still give fees to the system so that the voters still can collect some of those stable coins or correlated assets. I think that's very interesting. I think it's very clever, and I like it. Okay, so there is that Ramses. Okay, moving on. Here at Balancer. Balancer's been getting like, it's like a boxer who's just been like, who's just stuck in the corner, just getting hammered, right? So we received an Immunify report regarding the rebalancing CLAAM pools, and out of an abundance of caution, we paused all the pools while we investigate. Now you can go to Balancer and you can withdraw, but you cannot deposit, and I believe the trading is, maybe the swapping through those pools is also paused, but you can't deposit. So they're trying to make sure that people's assets are safe, in the sense that like an exploit can't happen while they read this Immunify report. Okay, Immunify is fantastic, and I do have an article here from Mitchell Amador. He wrote an article that says basically, you know, Immunify's the king. He compares them to Hackerproof, Cantina, HackerOne, Sherlock, and 92.33 of all critical vulnerability disclosures flow through one platform. Here's the data. Immunify. So Immunify is becoming the king of white hat bug bounty type things, right? Like just auditors. And it's fantastic that, like, it's obviously it's not great that it's kind of monopolized into one protocol, but the only thing that matters is that the people who do this sort of assessing, these white hat hackers, have a place to go and get paid for doing their bug bounties and are happy to do it. That's the only thing that matters. Whether or not there's a large plethora of different options doesn't really matter as much as the fact is that these people are incentivized to do what they're doing, and I'm happy to see that. Now I'll share this article, of course, if you really want to dig deep into the weeds, and why it's basically explaining why Immunify is so successful. Okay, moving on. Okay, I talked about that. I don't know. Legion has a tweet here, and it says what TradFi got right about investing vetting, and what crypto can learn. So it's a long article in here. It basically says, like, crypto does have some problems with the way we kind of have done investing in the past. And like Legion's idea is, the whole point of Legion is to allow individuals to participate in ICOs, which is, in my opinion, a fantastic endeavor. I have participated in ICOs via Legion, and I was happy with my experience there. And you can read through this and kind of see what they're talking about, but I just wanted to share this. I don't want to get into the details of it so much. I just wanted to share this article and the idea of, you should probably consider looking at Legion. I want Legion to succeed because I like their ethos. I don't want crypto to become the way TradFi or early crypto investing was, and that is where only institutions and large net worth entities could invest in projects, and then the plebs had to come in late and try. But so I like this idea. I like Legion and I want them to succeed, so I thought I would share this article with you, and you can read through it and get a better understanding of their vision. Okay, now tariffs. This is one thing I don't really like. Now, I talked about in the DAO stuff where I talked about the individual voice doesn't have any kind of power in modern society, right? And that's what I wanted. I wanted to come back to that with this tweet here. So the Kobayashi letter says, breaking, the Supreme Court of the U.S. has officially ruled that President Trump's tariffs are illegal in a 6-3 ruling. So 9 people decided that what President Trump campaigned for, he spoke on this like in abundance. He said again and again and again during his rallies and all of his voting to get people to vote for him. He said he's going to use tariffs to do this, and people voted for him. So the people in majority, the people want this. They wanted him to do this. So the country wants the president to use tariffs to do this. Now, I'm not a tariff expert. I don't know if tariffs are actually working or if the American users are actually suffering because of it. And some people are saying that that's the fact, that tariffs are not actually working. What they're doing, in fact, is they're just increasing the prices of stuff for Americans. That's what some people are saying. I don't know if it's true. It's obviously effective in the sense that Trump is getting countries to do what he wants them to do with these tariffs. But now 9 people have decided, 6 of the 9 have decided to ignore what the entire population has voted for, or the majority of the population has voted for, and have said, it's now illegal. And now we don't know what's going to happen. It says the U.S. now faces $150 billion in potential tariff refunds. Maybe the laws are true. Maybe these Supreme Court lawyers. Now, if the law was clear, then it would be 9 of 0, not 6 of 3. There's interpretation, right? So that the law is not 100% clear. But my issue is that 9 people are speaking for the population of America. And only actually 6 of those 9 are speaking for the population of America. The 3 people who voted against this, saying that he was fine, they're speaking with the population. And I think that's wrong. If the population wants tariffs, the population should be able to do it. And these Supreme Court judges are not elected officials. They don't represent the people. They are put into, I don't know how they're put in there. I don't know. I'm not an American, so I don't really care that much. But this affects everyone in the entire world. So this is my thoughts on this. I could be crazy. I could be stupid. I could be dumb. I don't know what the hell I'm talking about. But I do. And, there are a lot of people who voted for Trump purely because they like his haircut. They like the things he says. They didn't want Sleepy Joe, right? Or they didn't want Kamala, so they voted for him. They didn't care about tariffs. They didn't think about it. There is that situation as well to consider. So, my point could be not completely 100% accurate, but he did, campaign on it a lot. He did say a lot. I'm going to tariffs. And people voted for him. And now these 9 guys, or 6 of these 9 guys, have decided, oh, no, we disagree with this. So let's change it. And I think that's totally wrong. Moving on. Last one. So here's Rectimedes. Rectimedes talks a little bit about this. I'm going to read what he says because I respect his thoughts and what he has to say. And I haven't even actually read this yet. So I'm just going to share it because he is talking about this Supreme Court thing. So the Supreme Court just ruled against Trump's tariffs like we've been expecting. It's a little nuanced because they didn't rule against all of them, but it still looks like the result is going to be a big mess of uncertainty regarding refunds, etc. I think what that uncertainty will push markets lower for the next 2 or 3 weeks. Yeah, so he's like, get ready for your bags to dump. That's pretty, yeah, I agree with this. So I might set up some limit orders lower than where we are right now. Which will provide more insane legendary entries before the Giga Moon to Valhalla. I hope that does happen. I plan to slurp up the Dipperino most expeditiously during that time. Then Wash will replace Powell in May. They'll drop interest rates, and $32 trillion of U.S. real estate equity will finally unfreeze. It will flood into the risk assets, and the long-awaited bull market will arrive. I hope so, Rectimedes. I really do, and I'm going to probably do the same thing he's going to do. Not financial advice, but yes, that. Okay, so that's it for today. I hope this has been an interesting talk, and I hope you've enjoyed this. And thank you so much for listening, and goodbye.